Imagine this, you're in Dubai or Toronto or London and you get a notice from the Indian tax department. You haven't lived in India for the last 6 years, you've paid taxes in your country of residence, your money is clean, your conscience is clear, you assume it's a system error. It isn't, and here's the problem, and you're not alone. Over 150,000 NRIs have received notices exactly like this, and the number is climbing. But here's the part that should actually concern you. Almost none of them knew they were doing anything wrong. That's what makes this dangerous. No fraud, no evasion, just quiet everyday financial decisions, transferring money home, buying a flat, earning interest, things that seemed completely fine until they weren't. I've broken down 7 exact reasons NRIs are getting flagged right now, including the ones that catch even careful, well-advised NRIs completely off guard. By the end of this video, you'll know exactly where the gaps are and how to close them before a notice finds you. Let's get into it. And some of these will actually surprise you even if you think you're doing everything right. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. I've seen these exact situations play out with real people, so let's go through them one by one, starting with the ones that surprise people the most. Before we get into the 7 reasons, you need to understand one thing, because without this, the reasons won't fully make sense. The income tax department today is not the same system it was 5 years ago. It uses two tools like AIS, the Annual Information System, and TIS, the Tax Information System, that pulls data automatically from your banks, property registries, mutual fund houses, and every high-value transactions linked to your PAN. It doesn't wait for a tip-off. It doesn't rely on someone flagging you. It just runs, connecting every dot, comparing every number, and checking it against what you have filed. If your ITR doesn't match what the system sees, you get flagged. Automatically, no humans involved. That's the world every NRI is operating in right now. Keep that in mind as we go through each reason. See, the system doesn't ask if you made a mistake, it only checks if your data matches. So, reason number 1, not filing your ITR. This is the most common mistake and it trips up even financially savvy NRIs. Most people know the rule. If your taxable income in India is below 2.5 lakhs to 4 lakhs, depending on which tax regime you are opted for, you technically don't need to file an ITR. That part is correct. What most people miss are the exceptions. If you have done certain high value transactions in India, you are required to file even if your income is 0. Specifically, if you have bought a property above 30 lakhs, made large investments, or deposited significant amounts into an NRO account, filing is mandatory. Let me show you how this actually plays out. Rajan lives in Toronto. He buys a flat in Pune for 48 lakhs using savings he built in Canada. From this property, he gets 0 rental income. He earns nothing in India, so in his mind, nothing to report. 6 months later, a notice arrives. Why? Because the moment that property was registered, the registry automatically reported that 48 lakhs transaction to the income tax department. The system sees 2 things: a 48 lakh property purchase and no ITR filed. That mismatch is all that it takes. The fix? File a nil return, no tax, no complication. It simply tells the system, yes, I know about this transaction and here's the explanation. Reason number 2, tedious mismatch with Form 26 AS. Now, let's say you did file, you check the box, ITR submitted, CA confirmed you're done. Not so fast. Filing is only half the equation. What's in your return still needs to match with what the system already has on record. And this is where a surprising number of NRIs get caught out. There's a document called Forms 26 AS. Think of it as a master ledger that records every single rupee of TDS deducted against your PAN. Whether your bank deducted TDS on your NRO interest or a tenant deducted TDS on rent, it's all in there. And here's what the system actually does. It compares your Form 26 AS against your ITR line by line automatically. Even a small mismatch triggers a notice under section 143(1). No human involvement, it's fully automated. The fix is straightforward. Before you file anything, log into the income tax portal, download your Form 26 AS, download your AIS, manually match every single entry against your ITR. Don't assume your CA has caught everything, verify it yourself. 5 extra minutes here can actually save 5 months of headache later. If this is helping you see things a little differently, hit the like button and subscribe. It helps me make more of such content for you. Alright, let's get back to it. Reason number 3, not declaring income that originates in India. Suresh sold his apartment in Hyderabad for 85 lakhs. He had been planning this for a month. He had a new property lined up. He figured reinvest the money, tax problem solved. He was wrong. Here's the thing most NRIs don't realize. Reinvesting doesn't erase the capital gain. It can reduce your tax, but only if you first declare the gain, then claim the exemption. Suresh skipped the declaration entirely, and here's why that was a problem. The property registry had already sent the sale details, amount, date, everything directly to the income tax department. The system knew the transaction happened. It knew the value. When Suresh ITR showed nothing, notice was issued. This is true for all India source income. Rent from your property here, capital gains on shares or mutual funds, interest on your NRO account. As an NRI, you are not taxed on what you earned abroad, but you're absolutely taxed on what originates in India. And the system is watching for it. Reason number 4, large unexplained transaction or deposits in your NRI account. Here's a question. If you transfer your own money you have already paid tax for abroad, into your India bank account, can the India tax department come after you for it? Technically, no, but in practice, it happens all the time. The moment money lands in your India bank account, the bank reports the transaction to the income tax department directly. And if there's no ITR or if your return doesn't clearly explain the source, the system flags it as unexplained income. Anjali is based in Dubai. She transfers 25 lakhs to her NRO account to renovate her parents' house. Completely clean money, already taxed in the UAE, but there's no ITR filed, no FIRC, that's a foreign inward remittance certificates, no documentation ready. A notice arrives later asking her to explain the source of funds. What should have been a 2-minute explanation became a 3-month ordeal, which is entirely avoidable. The fix: always keep 3 documents ready. Your bank statement, which is your foreign bank account statement, your salary slips or income proofs, and your FIRC. 3 documents, that's the difference between a clean explanation and a 3 months of nightmare. Reason 5, wrong residential status on your ITR. Priya has been living in London for 4 years. She files her ITR or income tax return every year diligently, on time, and she thinks she is doing everything right. But she's been filing her income tax return as a resident, not as an NRI. One small checkbox, 4 years of incorrect filings. Here's why that matters more than it actually sounds. When you file as a resident instead of an NRI, the system doesn't read it as a minor clerical error. It applies an entirely different tax profile. Different income becomes taxable, different deductions apply, different rules govern everything. This creates a mismatch between Priya's income, her TDS, and the rules system expects to see applied. The system actually catches it. Also, in a resident return, non-reporting of foreign assets also triggers a 10 lakh penalty, which in first place was not even applicable. Net, it is the beginning of a formal process: revisions, explanations, potential penalties. The fix is simple, but it requires you to actually check. Every time you file your return, confirm your residential status yourself. Don't assume your CA has it right. This one checkbox doesn't just define your status, it defines how your entire income is interpreted. If you have been living abroad and haven't verified this, check your last ITR today. Reason number 6, claiming DTAA benefits without the right documents. If you live in a foreign country that has a tax treaty with India, countries like the US, UK, UAE, Australia, Canada, etc., you can pay a lower tax rate on certain Indian incomes. This is called the DTAA benefit. It's completely legitimate and you should absolutely use it. But most people get it wrong. Not in intent, but in execution. They claim the benefit, they just don't submit the documents required to support it. There are 3 documents you cannot afford to miss. One is your tax residency certificate, also called as TRC. Second is Form 10F. And third, a self-declaration of beneficial ownership. Without these, the tax department has every reason to reject your claim. The benefit gets invalidated, a mismatch is created, and the mismatch is often exactly the trigger for scrutiny. And reason number 7, not reporting income that's exempt from tax. And this is the one point that surprises even the most financially aware NRIs. And honestly, it's the insight I want you to remember most from this video. Exempt from tax doesn't mean exempt from reporting. Interest in your NRI account is actually tax-free. FCNR deposits returns tax-free. Money transfer from abroad, not taxable in India. All true, but every single one of these still needs to be declared under the exempt income schedule in your ITR. Here's why. AIS, which is your annual information system, now captures over 50 categories of financial transactions. Banks, financial institutions are reporting your interest income, your deposits, your transactions directly to the income tax department. They don't wait for you to tell them. Let's look at an example. Mira has an NRI fixed deposit earning around 2.8 lakhs a year. She shows it as tax-free, so she doesn't mention it in her ITR. Why would she actually, right? There's nothing to pay, but her bank has already reported that interest to AIS. The system sees income on record, nothing in the income tax return, gap is flagged, notice is generated. Most notices today are not about unpaid tax, they are about data mismatch. Reporting exempt income costs you nothing. No additional tax, no penalty. It simply closes the gap between what the system sees and what your return says. In today's environment, that alignment isn't optional, it's your first line of defense. I want to leave you with one thought. Every single person we talked about today, they weren't careless people. They weren't trying to evade anything. They were just going about their lives, making normal financial decisions, assuming that no news meant no problem. The system doesn't work that way anymore. It's already watching. The only question is whether your ITR is telling the same story. And remember, the tax department can go back up to 6 years. A gap you leave open today doesn't expire, it sits there quietly until it doesn't. So, before filing ITR, do these 3 things. Download Form AIS and Form 26AS today. Cross-check every single entry against your ITR. If you spot a gap, talk to a CA who actually specializes in NRI taxation. And if this video helped you see something you haven't seen before, share it with one NRI who needs to hear it. Not for me, for them. Because the cost of not knowing this isn't a YouTube comment, it's a notice and months of stress that nobody needed. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Nikki. Thank you for watching, and I'll see you in the next one.